Joining us by phone, Samana, Wells Fargo Investment Institute Senior Global Market Strategist. Samir, when you jump on the calls with clients this afternoon, what do you tell them about the economic and market risk of a potential Russian invasion of Ukraine?
I think probably the first thing that we tell them is, look, this is something that, at least history would tell you will probably be acute. Now, that doesn't mean that it couldn't drag on into weeks and months, but, whether it's the previous, invasion of Ukraine, back during the Sochi Winter Olympics or, other, different scenarios that are kind of like this, they eventually kind of resolve themselves. And what ends up kind of driving markets over the medium to kind of long term, is fundamentals and earnings and, all those other things that really matter. Now, in the short run here, as Paul mentioned, you could have an oil spike. That could be, something that at least in the near term, pushes you towards an economic slowdown, especially when you take into account how the Fed and a lot of other global central banks are moving towards tightening. So you can't rule out some type of, short-term, economic crunch. But again, medium to long term, I think what you're realizing is once we get past COVID, once we all return to work, there's really healthy demand for goods and services.
Mm-hmm. A short-term economic crunch, Samir, but, if you have more than $100 a barrel oil, whether it be WTI or crude, on top of the inflation that we've already seen, that is a crunch that is pretty painful. Does that change your view of various sectors or of what the Fed does?
So we've kind of been positioning for a world that has inflation becoming more sticky, really since last year. So one of our best calls, one of our favorite calls is commodities. And, both natural gas and oil have done very well. And so, we've been advocating to clients to get that exposure if they don't have it already. We had been, really very unfavorable in energy until, call it late 2020, when the vaccines started to roll out and we upgraded to favorable. We're neutral currently because we thought oil had already gone maybe a touch too far. But, clearly geopolitics is a little bit of a wild card, but neutral means a full weighting. So we want folks to be tilted in that direction. And then, we look at other cyclicals. Financials do very well when inflation ticks up. Industrials, to the extent that you have to do more exploration and production for energy. That's a very intensive activity. A lot of the industrial companies do well. And then we still like tech. We think, things like geopolitics will keep rates on a glide path that's not terribly disorderly. And so, a lot of the profitability we still see for larger cap tech should do pretty well.
What about Safehaven, Samir? We're seeing gold pop 1.4% today. Treasuries are in demand. The U.S. dollar getting bought. What is your preferred way to have some sort of safety hedge in your portfolio if indeed this does happen?
Probably the best thing to do right now is, one, don't overreact, right? To your point, stocks are already down. Commodities have done well. So, one of the things that we would advocate to clients is, look, if you do have those commodities exposures, if you do have some of those cyclical exposures, those areas have held up a little bit better. It's okay to rebalance, right? It's okay to sell some of that energy allocation if you've become overweight and, rotate back to cash. It's okay to sell some commodities and rotate some of that back to cash. We probably wouldn't go to the fixed income side, at least to the longer duration areas. But, you could probably park it in the short to medium term. Again, with the Fed about to raise interest rates, this is not the time to take duration risks. So we would say, having that optionality that cash provides probably is a pretty good thing for investors to keep in mind as we go through 2022.